All right. Today is Sunday, February 6th. This is a recap for the stock market activities last week and an outlook for the week to come. Folks, I got a good one for you tonight, but let's start with this. Thank you to all of the subscribers and the viewers of this channel. Without you, this would not be possible at all. Obviously, YouTube doesn't like the channel, so we're not getting any favors from the algos, but it is due to your activities of pushing the like button, subscribing, sharing, and most importantly, commenting on each video. The channel is becoming too hot to ignore. So thank you for doing that, and by the way, don't think that I ignore your comments. I spent this weekend reading over 3,000 comments on this channel throughout the week. And if you're gonna say, well, I don't know what to comment on, I got no comment, easy. Just type whatever you ate for breakfast today. Doesn't matter to me. I don't judge. You woke up hungover and you saw the bottle right next to you and you took another shot and you went back to sleep. That's breakfast. Doesn't matter to me. You woke up tired. You sat on the couch and you found a piece of couch pizza from last night and you ate that for breakfast. Doesn't matter to me. I don't care. I don't judge. You woke up in the morning. You ate ass for breakfast. Doesn't matter to me. With this inflation, donkey meat is an affordable and a healthy choice. I don't judge. So keep doing that. And with that out of the way, here's what I want to do with this video. I want to talk macro first and then we talk about market information, who's buying the dip, who's not buying the dip, what's going on with the market overall. So let's do that, and here it is. In focus tonight, cooking the data. It is not just laughable, it is embarrassing at this point. What am I talking about? Here's what I'm talking about. On Friday, we got the much anticipated jobs number, and here it is. The U.S. economy added 467,000 jobs in January, and the hiring was much stronger at the end of 2021 than originally reported, indicating businesses did a better job of recruiting workers to fill near record number of open jobs. So far, so good. Here's another headline just to illustrate for you the massive orgasm we got from the corporate media in the morning on Friday. Payrolls show surprisingly powerful gain of 467,000 jobs in January despite the Pokemon surge. So what is the problem here? What are you upset about? Here's what I'm upset about. Notice the disparity between the ADP jobs number, which counts the private sector of the economy alone, versus the government number, the Bureau of Labor Statistics, aka the kitchen, which counts the public and private sectors combined. In the month of November, the ADP report showed that the private sector of the economy alone created 534,000 jobs. On the other hand, the kitchen told us that the economy entirely, private and public combined, created only 249,000 jobs. In December, the ADP report showed a gain of 807,000 jobs versus the BLS that showed 199,000 jobs for the entire economy combined. For the past month of January, the ADP report showed that the economy lost 301,000 jobs in the private sector. On the other hand, magically showed a gain of 467,000 jobs for the economy, public and private sectors combined. So there is a massive divergence here. Somebody's lying. Who's lying? Is it the private company, the ADP, or is it the government cooks at the Bureau of Labor Statistics? I think the answer is clear. Yes, every month we get revisions of the past number, and these revisions are a natural byproduct of statistics. These revisions happen, but they shouldn't be by a lot, because if that is the case, then somebody is cooking the data. And here it is. The headline reads, why did the U.S. Labor Department report a surge in January payrolls while the ADP Research Institute saw a big drop, ? It comes down to abnormal times, quote unquote, and this is according to ADP chief economist Neela Richardson. And I say forget about abnormal times. It comes down to the cooking of the data, the market manipulation by the government cooks at the Bureau of Labor Statistics. Listen to this. December, which initially was reported as a gain of 199,000 jobs, this is according to the cooks at the Bureau, went up to 510,000 jobs. This is the revision. How could you miss by this much? How could you say it's 199,000 jobs, and then the very next month, when nobody's paying attention to the previous number, you revise that number by more than double? This is laughable, folks. It's unbelievable, but it gets even better. November surged to 647,000 jobs from the previous reported 249,000. For the 2 months alone, the initial counts were revised up by 709,000 jobs. How could you miss on 709,000 jobs? It's impossible, except for the fact that you're cooking the data. And here comes the excuse. The revisions came as part of the annual adjustments from the BLS that saw sizable changes for many of the months in 2021. Give me a break. Look at all of these revisions, by the way. They're missing by a lot. How could we trust the Bureau of Labor Statistics anymore? I can. I trust the CCP numbers from China more than I trust the Bureau of Labor Statistics numbers. And here's why, folks. Here's why they're manipulating the data. Notice in November, they played down the number, and they did so in December. Why are they playing down the numbers? For a simple reason: market manipulation. Because very good news, economically speaking, is very bad news for the stock market. Why do we continue to see this phenomenon? The answer is because the Fed has manipulated the market to become dependable on the Fed's liquidity, aka the cocaine. In other words, a hot jobs report will get us closer to the so-called maximum employment threshold by Jerome Powell. If we get closer to that threshold, then the Fed will withdraw the so-called accommodation from the stock market, meaning they will hike interest rates, they will stop buying assets, and they might unwind the balance sheet. All of these are bad for the stock market because the stock market has been an addict, a drug addict, a junkie to the Fed's liquidity. The stock market doesn't care about the economy anymore. The stock market doesn't care if we have civil wars, World War III, asteroids hitting the planet, the extinction of humanity. That doesn't matter to the stock market. Pandemics, for sure. Doesn't matter. What matters is the cocaine. And so long as the cocaine continues to flow into the stock market from the Fed, stocks go higher. But if that ends, the stock market crashes. Why would that end, meaning the cocaine? It would end because inflation is surging out of whack. That is mandate number 1 for the Fed. Mandate number 2 is maximum employment. So if you have higher inflation at maximum employment, then you no longer need to issue the so-called accommodation to the stock market. And this is why the cooks at the Bureau downplayed the number in November and December. So why did they play the number higher this time around? The answer is because we know that the Fed will tighten the monetary policy either way. It's in the bag now. We're pricing in at least 5 interest rate hikes this year alone. Why? Because inflation is surging out of whack. So what they did this time around is that they sent their BlackRock propagandist Brian Deese to come out and say, folks, the number we're about to get on Friday is going to be bad. So temper your expectations. Downplay your expectations. And you and I know that the stock market is a game of expectations. So we got into the number expecting a really bad reading, perhaps a negative reading. And what do we got? A hot number, beating, smashing expectations higher. And hence the reaction from the stock market. Because they now know it doesn't matter if you downplay the number. The Fed will tighten the monetary policy anyways. And the concern for the stock market right now is the Fed tightening the monetary policy while we have a stalling economy, a stagnant economy where the pace of economic activities and growth is slowing down. This is the main concern for the market. But giving us a hot jobs number on Friday negates the expectations that growth and the pace of economic activities in this economy is slowing down. You see what I'm saying? And hence the positive market reaction. Because the market is saying right now, wait a minute here. We know the Fed's tightening, but at least they're not tightening amidst a slowdown in the economy. Matter of fact, the economy remains hot. Look at the jobs we created despite the Pokemon. And here's my prediction. Watch out for next month's reading, because they're gonna revise this number down by a lot when nobody's paying attention. You watch. Let's continue to read here because I got more bad news for you, despite the hot number at face value. And here it is. Earnings also rose sharply, accelerating 0.7%, and this is good for a 12-month gain of 5.7%. and providing confirmation that inflation continues to gather strength. Wage inflation is moving higher. We're now gaining 5.7%. But before you start celebrating, hold your horses. That yearly move was the biggest gain since May 2020, when wage numbers were distorted by the thing. The rate of wage gains, however, still lags inflation. Are you paying attention or not? Which was running around 7% in December, as gauged by the Consumer Price Index. In other words, you gained 5.7% of your wage, but you're down either way because inflation, at a minimum, is at 7% year over year. So net, you're down about 1.3%. And here is Bloomberg's Lisa Bromowitz. She says wages were up 5.7% year over year in January, still not enough to keep with the headline CPI, but remarkable. Here's the problem, and this is from the Washington Post. The headline reads, rents are up more than 30% in some cities, forcing millions to find another place to live. So again, if your wages went higher by 5.7%, yet your rent went higher by 30%, is this really an economic boom? Or is this just an economic boom for one class of the population, meaning the rich, who are seeing their assets surging, be it stocks or real estate, while the rest of us are suffering? And it's not just rent prices, by the way. Look at gas prices. Some U.S. drivers may pay the highest gasoline prices of their lives this spring. What are they talking about? Here it is. Gas prices climbed to the highest level in more than 7 years as oil surges above $90 a barrel. And for now, many seasoned commodities traders are saying that $100 a barrel is pretty much in the bag right now. So it's going to get worse. Inflation is surging out of whack. The majority of the population is losing to inflation, and the Fed will have no choice whatsoever but to tighten aggressively to tame down inflation, which is not good for the stock market, by the way. It's going to crash the stock market and perhaps the real estate market. So the cooks at the Bureau of Labor Statistics thought that they're smart by giving us a hot number on Friday. It worked for a day on Friday, but the problem is a hot jobs number is going to fire back, and the reason is when Jerome Powell looks at the data, we're about to get the CPI, by the way. Let's say the CPI comes out hot. And it should come out hot. Just look at commodities prices. Look at crude oil prices. The CPI will come hot. But Jerome Powell already knew that. He knows that inflation is surging out of whack, but his excuse was, I'm waiting for maximum employment. Well, a hot jobs reading on Friday gets us closer to the so-called maximum employment, even though the number is fake. So Powell will have no choice but to tighten aggressively comes March, perhaps by 50 basis points right now. And on top of that, the kitchen will come out and say, remember that hot jobs number that we gave you last month? We're revising that down. We actually lost about 500,000 jobs in January. So we come back to the same conclusion. The Fed is tightening the monetary policy while the economy is slowing down. A lethal recipe. Continuing. There were more good jobs news, and bear in mind, good jobs news equals bad news for the stock market because it gets us closer to maximum employment. Here it is. The labor force participation rate rose to 62.2%, a 0.3 percentage point gain. That took the rate, which is closely watched by Fed officials, to the highest levels since March 2020, and within 1.2 percentage points of where it was pre the thing. This is maximum employment, Mr. Powell. You have no choice now but to tighten. And here it is, the result of all of that. As you can see, market expectations of Fed rate hikes moved higher after the payrolls came out on Friday. So we're now pricing 132 basis points in the bag for the year. And perhaps 50 basis points comes March. I'm telling you right now, the stock market is not going to be able to handle that. And look at Jerome Powell with a dumb look on his face. I have to do this now? Yes, you do, because inflation is surging out of whack. Be it the CPI or the core CPI, which the Fed likes. Even the core CPI is at 6% year over year. And by the way, remember what Dr. Friedman has taught us. Inflation is always a monetary phenomenon. But most importantly, there is a so-called honeymoon phase of inflation. Just like in drinking, it starts out good and then it becomes really bad. The honeymoon period of inflation means that corporate profits are expanding, wages are moving higher. So far, so good. Everybody wins. Workers are getting a bump in their wages, corporations are hiking prices higher, and the consumer remains receptive. Hence, it's a win-win. The economy expands, GDP moves higher, and then we start to see the ugly side of inflation. And perhaps we are already there. The headline reads, rising costs and inflation are reshaping fast food, forcing chains to cut portion sizes and hide the value menu. And it gets even better. Perhaps this is an alarming sign that we're about to see this in the economy. Stanley Black & Decker confirms layoffs, citing supply chain challenges and inflation. So inflation was good in the beginning for this company. Orders were skyrocketing, demand was high, they were hiking prices, hiring more people, but now inflation is so high and the demand is slowing down. Hence, we are entering a stagflation phenomenon in the economy, and this company will now have to lay off workers. We're about to see this happening in many other companies, by the way. How could they not, when the average delivery time for U.S. manufacturers is pretty much at all-time highs? The demand has to slow down, and the reason is nothing is moving when it comes to the supply chain, because the supply chain got overwhelmed with out-of-whack demand fueled by the Fed's cocaine policy. And now the supply chain is overwhelmed to fulfill orders from last year. So you as a consumer, when you see the wait time 4 weeks, 5 weeks, 2 months, 3 months, doesn't make sense to order right now, specifically given the out-of-whack prices. And hence we are entering a stagflation phenomenon in the economy, which will cost us a lot of jobs. But rest assured, the delusional IMF chief says it is too early to say if the world is facing sustained inflation. And here comes Larry Summers, who said that the idea of inflation reverting soon to levels near the Fed's target looks like a quote-unquote long shot. Not gonna happen, despite the fantasies. Here's another headline for you from Kyla Touche. She says the Fed influence, shaky forecasts, and delayed decisions, how the Biden administration misread the inflation threat. And I say, really? Is that really what happened? Because these people have all the Harvards and Yales, the Goldman Sachs and BlackRocks of the world. But somehow a douchebag YouTuber with 50 subscribers got it right from the get-go. Ever wondered why that happened? I'll tell you why. Because I read the facts, I read the data, I come up to the conclusion, and I don't care where the conclusion lands. Let the chips fall whatever they may in the so-called political spectrum. But these morons have political agenda, and therefore they manipulate, distort, weasel around the facts just to fit their political narrative. And this is the real reason on how the Biden administration and the Fed misread the inflation threat. And why is it a threat, by the way? Because now the Fed, being way behind the curve, will have to hike interest rates aggressively. What is the problem with that, you might ask? The problem is it's going to blow up the entire economy. Certainly the stock market, but perhaps the entire global economy. Why? Because of this. The amount of corporate debt maturing within 5 years is at all-time highs. And trillions of that debt is, by the way, junk bonds and junk loans. Oh boy. On top of that, the U.S. debt, all in all, government, households, and business, has increased to all-time highs. Higher interest rates will mean tightening of the standard of living, tightening of spending, tightening of the pace of economic activities, because a lot of that wealth will have to go on paying interest rates. Certainly good for the banks, not for the economy. And here it is. Higher interest rates could spark a debt crisis. Why? Because the projected federal debt by 2051, under various scenarios, the baseline says the federal debt will be at 202% of the GDP and the interest rate will be 4.6%, meaning we could see the collapse of the entire U.S. economy. And even the Romans are looking at this and say, oh, these people are crazy. Anyways, here's another one. Sound the alarm. National debt hits $30 trillion. Uh-oh. Where did the 30 trillion go, by the way? Do you see bridges and railroads and nice airports across the country? Do you see the U.S. population enjoying free health care, for example? Of course not. You go to China and you come back to this country, you land at the airport and you feel that you just landed in a third world country. We're so behind. So where did all of that money go, the 30 trillion? The answer is in the pockets of bankers, big pharma, the military-industrial complex, the rich, the oligarchs, the stock market. This is where all of these trillions went, to prop up the assets of the rich. But I know what you're going to say. You're going to say, who cares about the national debt, right? Janet Yellen says, it doesn't matter because interest rates are low. Whoops. Interest rates are about to go higher. Rising interest costs are becoming the fastest growing part of the federal budget. That means more of the taxes taken out of Americans' paychecks will go, quote, to our past rather than our future, end quote. Whoops. Your taxes are gonna go higher, baby. Somebody's gonna pay for all of that, and it ain't gonna be the rich. A large national debt can make the country less prepared for other disasters, such as the next recession or pandemic, and make it hard to devote money for social programs for the most vulnerable Americans, such as the poor and the elderly, who are, by the way, the victim of all of this financial engineering of the economy by the Fed. Continuing, over time, the growing debt can push up interest rates for consumers and businesses. The high rates can ripple through the economy, nudging up rates for mortgages, corporate bonds, and other type of consumer and business loans. We are very fortunate that interest rates have been so low in recent years because it lowers the burden of all of this debt, somebody said. He also added that gives us additional breathing room, but the scary part is it could be quite temporary. As interest costs rise, that debt burden becomes more and more painful. In other words, who's going to pay the tab here? The answer is the next generation of Americans, the Gen Zers and the likes, not the oligarchs, not Bezos, who wants to fit his giant mega yacht by dismantling a historic bridge. And had we taxed this right, we could have used the money to build bridges in this country where infrastructure is crumbling. And by the way, it's not just the Fed who's raising interest rates higher. It's the entire central bank cabal is moving in the same direction now. For example, the Bank of England also jacked rates higher this week, even though the ECB remains so-called accommodative. And in case you didn't hear this criminal, the Bank of England chief, Bailey, he said if you want to tame inflation down, stop asking for higher wages. Meanwhile, this animal catches $780,000 a year in salary. Yet he says, hey, stop asking for higher wages. We gotta control inflation here. And just a reminder for you, comes April, at least 2 million UK households will dip into poverty when the energy price cap is removed. Yet this guy has the nerve to issue this comment. But regardless, traders are now seeing more interest rate hikes from the Bank of England, and they're betting that the BOE rate will hit 1.5% before the end of the year. And I say make that 2%. Even the ECB, which remains delusional and has yet to raise interest rates, they're also issuing a guideline to slow their net purchases. And they say that by March of 2023, they're not going to purchase anything, meaning the accommodation will be removed from the stock market. And I say this, they're going to be forced to end all of the purchasing programs before the end of this year. Forget about March 2023. And of course, we're waiting for more interest rate policies from different central banks across the world this week. On Tuesday, we have the Bank of Poland. On Wednesday, let's play a geography game here. We have India, and what is that? Korea? I'm not sure. And then we have another country down there. What is that? Romania? And then Thursday, we have I think that is Peru, and then we have Mexico, I better know that, and Sweden, because it is sandwiched between Norway and Finland, I already know that, a bunch of other countries in Europe, which I cannot name right now. What am I, a geography major? But anyways, I know this. That country down there, that's Indonesia, lots of islands. And then Friday, we have the big one, the Bank of Russia. The Bank of Russia has been already hiking rates higher, but it's interesting to see what they're going to say because it will become relevant vis-a-vis the tensions with Ukraine. Now, let's segue and talk about the market here. And we start with this. Folks, we are seeing historic times in the stock market. Unbelievable volatility, the likes that I've never seen before. Take, for example, the crash in Facebook stock, because that one was the biggest one-day drop in stock market history. Facebook erased almost $250 billion of its value. We've never seen this happen before. The last time we saw this magnitude of a drop was back in September of 2020 when Apple lost almost $180 billion in a single day. Yet on Friday, we also saw one of the biggest one-day gains in stock market history when Amazon surged double digits in a single day, or Amazon added $191 billion to its market cap. This is the largest one-day gain of any stock in history, right after PetroChina in 2007. The volatility is evident here. Since the beginning of the year, the stock market has been dropping, with extreme moves, until of course the later part of last month, when we for now should assume that was a bear market rally. As you can see, a downward trend since the beginning of the year, and then you see a massive pop for a few days. This is the bear market rally. Then it fades and we start losing again. So the assumption for now, the volatility will continue. Matter of fact, last month, we have seen more cash leaves the SPY, the S&P 500, than ever before. The biggest outflow in the history of the SPY. Unbelievable. What about the Qs? The Nasdaq, we also saw the biggest outflow of funds since the dot-com bubble. And the short interest against the Qs is surging higher to the highest level since March of 2020. Yet amidst all of this volatility, value stocks continue to outperform. For example, when you pin the volatility portfolio in white versus the value portfolio, and then you pin the growth portfolio versus the value portfolio in blue, and lastly, you pin the momentum portfolio versus the value portfolio in purple, as you can see, all of them are underperforming value because when interest rates move higher, value stocks tend to outperform. And here is a sentiment indicator for you. They ask entrepreneurs, specifically startup entrepreneurs, is it a good time to start a business this month, 2 to 3 months, 4 to 6 months, 7 to 12 months, or longer / I don't know. Now, a lot of folks could misread this and say sentiment is not this bad because when you ask startup entrepreneurs, is it a good time to start a business this month, meaning last month, January, the reading went higher from about 34.6% to 35.4%. But notice that the readings for longer periods went down. So my interpretation of this is perhaps entrepreneurs are saying this is a good time to start a business to squeeze whatever juice left in this bubble before it's gone. So this is, to me, at least, a bad sentiment indicator. So what are you saying, bro? Should we buy the dip or should we not buy the dip? Just give us the ticker already. Tell us what's going to pop higher, 20-30% tomorrow, and let's wrap it up already. Hold your horses, because historically speaking, at least going to data all the way to 1965, the average S&P 500 correction is at 21%. The average correction under a recession is 36%, while the average correction with no recession is 15.4%. Meaning, if you just use the average, we haven't seen the bottom yet. We need to drop at least 21% from the top. This is what history says before we find the bottom. But rest assured, the dip buyers are here. And they're not institutions, they're not corporate insiders, they're not the rich, they're the dummies, you and I, the retail investors, the mom and pops. The headline reads, retail investors bought the dip in January as institutions fled. What could go wrong, right? Mom and pop investors led purchases of U.S. equities during the month, while institutional investors such as hedge funds sold off assets, according to fresh data from Bank of America. Smart money leaves, dumb money buys. Bank of America retail clients were the biggest dip buyers last month, posting inflows into stocks in each of the last 4 weeks. They've been catching a falling knife here. January inflows are typically led by retail clients following tax loss selling, Bank of America noted, while institutional clients pour in during November and December after mutual funds' October 31st deadline for recognizing gains or losses. So you're not following smart money here when you buy the dip right now. It is more, Bank of America reported broad-based buying of the dip in this report, indicating that clients purchased both ETFs and single stocks last week and were buyers of all equities across all 3 size segments. Clients buying the dip in U.S. equities recorded $5.5 billion in total flows to stocks, the largest sum since late November and the 8th largest since 2008 per Bank of America's data. And it gets even better. Bank of America strategists see surging equity flows while bonds get dumped. So you hear all of these YouTubers, buy bonds, bonds are going to go to the moon. Yeah, keep waiting. Someday it might happen. But anyhow, equity funds attracted $21.8 billion in the week to February 2nd, bringing the year-to-date total to $1.6 billion. At the same time, bond funds had their largest weekly outflow since March 2021, and cash holdings also fell. So they continue to buy and they continue to catch a falling knife. Billions and billions of dollars of your money being poured in the equities market in the wrong time by the beloved banksters, of course. Sinister price action in corporate bonds coincided with big outflows, not the case in stocks year to date, said strategist Michael Harnett, who cares. In the past, high-yield outflows combined with large stock inflows have signaled big tops, quote-unquote, the peak, before sustained declines in equities. And it gets even better. Bank of America strategists remain bearish in equities, but they'll take your money and buy stocks with it. No problem. Predicting a rate shock in the first half of this year, following by a growth shock in the second, triggering negative returns for both equities and credit. And lastly, since we're talking about retail, buying the dip and all of that, we have the SEC perhaps waking up from the coma. Wow. Not to do the right thing, but perhaps to crack down. Against who? Against the criminals, the hedge funds, the market manipulators? Of course not. They're going to crack down on meme stock investors. That's the threat to the market. And by the way, all of you morons, the Robin Hoodites, the apes, the Game Stoppers, who attacked my channel and said, "You're a hedgie, you're just jealous, you don't know what you're talking about, you're boomer." Meanwhile, I was looking out for your ass in this jungle we call the stock market, which you have no clue how to navigate. And I tried to help you out, and you attacked me instead, because we want to stick it to the man. Well, here's the man. The headline read, King Griffin's Citadel flagship hedge fund gains nearly 5% during January's tech rout. So you lost money, but the man actually gained 5%. So perhaps by the man, you meant your asshole, because this is where all the sticking went. Anyhow, we're going to move on here and cover the market information for you. And here we go. On Friday, the Dow Industrial Average closed in the red, down by 21.42 points, or a loss of 0.06%, pretty much in the flat line. The Nasdaq, on the other hand, was higher by 219.19 points, or a gain of 1.58%. The S&P 500 also in the green by 23.9 points, or a gain of 0.59%. And what about the sector's performance on Friday? Leading the pack at number 1, capturing the gold medal, consumer cyclicals. Number 2 for the silver, energy. Number 3 for the bronze, technology. On the other hand, the laggards of the day led by defensives, REITs, and industrials. Let's contrast this with the performance for the week. Every single sector closed in the green. We're not going to shame anybody here. So despite the fear, the crash in Facebook, the market all in all did pretty good this week. And the gains were led by consumer cyclicals, energy, and financials. What about the advance to decline ratios on Friday? NYSE 51% advancing versus 45% declining. And the Nasdaq 67% advancing versus 30% declining. Despite the positive ratio, look at the 52-week highs. Only 21 stocks reached 52-week highs on Friday versus 166 of the stocks in the Nasdaq reaching 52-week lows. Unbelievable. Moving on to commodities. Look at what's going on here. On Friday, crude oil prices surged higher. Both the WTI and Brent are now trading comfortably above 90. The WTI gained almost 2% on Friday, while Brent gained a little over 1.5%. Likewise, we saw gains for gasoline and heating oil prices, while natural gas went down by almost 7%. And the volatility in natural gas prices is absolutely insane. I've been trading natural gas since I was a baby. I've never seen this kind of volatility, ever. Matter of fact, the volatility in natural gas prices is the highest in 26 years. What about softs? Look at lumber, lasting higher again, and now trading above 1,000 once again, gaining almost 4.5% on Friday alone. We also saw gains in cocoa and sugar prices, while we have declines for OJ. We thought OJ perhaps catching a bottom here. Not so soon. OJ was down almost 5% on Friday. We also saw losses for cotton and coffee futures. What about metals? We're seeing modest gains under 1% for gold, silver, and copper, while we have declines of over 1% for palladium. Likewise, platinum also down, be it modestly. What about meats? Live and feeder cattle pretty much muted for the day, while here it is, the new big tech. Lean hogs shooting higher and gaining over 2% on Friday alone, and now we're over 100. Forget about RKK, forget about the Nasdaq, forget about FANG. Lean hogs is the place to be. Until they get slaughtered, of course. What about grains? What's going on here? On Friday, we have gains led by wheat, soybean meal, corn, soybeans, and oats, while we have declines led by rough rice, canola, and soybean oil. And here are some commodities news for you. As you can see, soybean sales are surging, specifically from China. China continues to hoard commodities, in this case soybeans. The Brazilian output is not good, so they have to buy soybeans from the United States, and therefore pushing the demand higher. Where is the supply? It is nowhere to be found. You put two and two together, soybean prices are moving higher. And with the rise in soybean prices comes fertilizers. We talked about this chart not so long ago when we saw a dip in fertilizer prices, and I told you, watch how fast they're going to buy the dip here. And indeed, they're buying the dip in fertilizer prices. And lastly, what about lithium? Lithium prices surging out of whack due to the demand from the EV mania. But we have Mexico now saying lithium is too strategic for private investors. Mexico says you can touch my cojones, not my lithium. That's too private. When we look at the top producers of lithium, the number one producer is Bolivia. And you wonder why they toppled the Morales regime over there? And Elon Musk came out with a tweet saying that we invade whoever we want to invade, we take whatever we want to take, meaning Bolivia, because Bolivia is now too strategic to be led by a hostile regime to corporate America. We need the lithium. Next, we have Argentina and Chile, and all of these regimes, by the way, are changing to become more protectionists, specifically Chile. So corporations can dig lithium in Chile still, but you're going to pay higher taxes. What does that mean? Lithium prices are going to move higher. And oh, by the way, car prices are going to move higher too. With all of this EV mania, even GM and Ford transitioning to 100% EVs, the average price for a vehicle a few years from now will be out of the reach from the average American. What a beauty. Moving on to the options market, the big casino, what's going on here? On Friday, the hottest table by far was Apple with around 1.3 million contracts traded. About 58% of those were calls. And at number 2, PayPal. With a little over 1 million contracts traded on Friday, about 62% of those were calls. And at number 3, Ford. Dropped big on Friday, but some are buying the dip here. We saw about 1 million contracts traded for Ford on Friday. About 59% of those were calls. And here's a note for you folks. A lot of you ask me questions. I have puts, I have calls, I'm losing money, what do I do now? If you don't know what you're doing, you're gonna lose money. I promise you, specifically in this insane volatility. Why do I say that? Seasoned options traders watch implied volatility carefully. And what we saw so far is implied volatility peaked along with the VIX. As the VIX went down, implied volatility went down, not by a lot, but as you can see, in a lot of stocks, the implied volatility went down. We're still at historic highs. We're seeing the IV percentage at 90 plus for many stocks. Now, what does that mean when the implied volatility moves down? If you bought at the peak of the implied volatility, calls or puts, you paid a lot for the premiums. Meaning, even if the stock that you bought calls on or puts on, even if the stock moves in the right direction, meaning if you bought calls, it pops higher, you might be noticing that you're losing money either way. Why? Because you paid too much. You paid at the highs of implied volatility. And therefore, I continue to say, you gotta be extra careful right now. If you're gonna trade options right now, for the love of God, use the implied volatility in your advantage by opening spreads. And here it is, the unusual activities that took place in the options market on Friday. We start with the ticker QCOM, Qualcomm. They continue to buy the dip here by buying calls, in this case the 200 calls, with the expiration date February 11th, with expectations that Qualcomm could pop higher by more than 11.5% by then. And they paid about 40 cents apiece to enter this trade, all in all spending about $1 million. What about the ticker PYPL, PayPal? They're buying the dip here, in this case the 140 calls for the expiration date February 18th, with expectations that the name could pop higher by more than 11% by then. They paid about 80 cents apiece to enter this trade, all in all spending about $1 million. What about the ticker SPY for the S&P 500? They're buying puts this time around, the 394 puts for the expiration date February 25th, with the expectations that the name could drop down by more than 12% by then. They paid about 70 cents apiece to enter this trade, all in all spending about $650,000. What about the trade for the ticker ASO for American Sports and Outdoors, aka guns? They're buying calls here, the $40 calls for the expiration date April 14th, with the expectations that the name could pop higher by more than 9% by then. They paid about $3 apiece to enter this trade, all in all spending about $2.5 million. What about the ticker HP for, HP? They're buying calls here, the 35 calls for the expiration date March 18th, with the expectations that the name could pop higher by more than 8% by then. They paid about $1.40 apiece to enter this trade, all in all spending about $850,000. And lastly, what about the trades for the ticker XLE for the energy ETF? When I read this trade, psychologically speaking, the trader remains bullish, but they're getting more cautious cautious here because they bought a call spread, they bought the 74 calls, and they sold the 80 ones, and then they used some of the credit to buy puts, specifically the 55 puts, all for the expiration date April 14th. In other words, the trader is saying the XLE could pop higher, but the limit is $80. But if it doesn't, if we have a flush down, then my pain limitation is 55. I'm not taking more losses than 55. So the structure here is they paid about $1.60 a piece for buying these 74 calls. And then they received 60 cents a piece from selling the 80 calls. They used that 60 cents to buy the 55 puts. So all in all, what they spent on this trade is $1.60 a piece. That's all there is. They used the credit from the calls that they sold to buy a put. That cancels that. So they're left paying the $1.60 a piece for the 74 calls. So all in all, they spent about $800,000 for this trade. We're moving on to the heat map analysis. This is the heat map on Friday. Now notice that the corners of the stock market that are lighting up green on Friday were number one, financials. That makes sense because the 10-year yield popped higher. Energy also outperformed, and the reason is crude oil prices moved higher. But besides that, the so-called inflationary theme or the value/defensive theme underperformed big. Big pharma down, industrials down, materials down, utilities, REITs, the consumer staples down, all the value names, even within the EV manufacturers, Ford, Toyota, GM, all down. Yet what's lighting up green is the offensives corners of the market, the risk-on corners. We're talking about software, we're talking about the high multiple names, Snapchat, Airbnb, Twilio, Zoom, etc. So all in all on Friday, it was an offensive theme, but be careful here, because my reading of the action on Friday was a lot of short covering in the names that have been losing last month. On the other hand, taking profits from the outperformers of last month, with the exception of financials and energy. That's all there is. Now let's contrast this with the weekly heat map, and believe it or not, pretty much everything in the stock market worked last week. Despite the chaos, despite the scary headlines, despite the crash in Facebook and PayPal, all in all, the stock market did pretty impressive for the week. Financials, tech, healthcare, energy, cyclicals, it didn't matter. Every corner of the market was moving higher, with very few exceptions due to earnings. And here's the daily heat map for the ETFs on Friday. Again, as you can see, growth outperformed value by a lot. Yet my reading is that we're seeing a lot of short covering in growth, because this has been the underperformer since the beginning of the year. Likewise, on Friday, chips were higher, the SOXL, financials, cyclicals, healthcare, energy. The losers were materials, industrials, the staple giants, utilities. The defensive corners of the stock market did not perform at all, as you've seen from the previous heat map. Your job here is to look at this heat map and look for consistency. Which sector of the market or sectors of the market have been outperforming so far, regardless of the themes or the rotations or the drops or the pops in the stock market? Which ETFs have been outperforming? My reading is energy and consumer staples have been outperforming regardless. Matter of fact, when we switch to the weekly heat map for the ETFs, as you can see, energy is the outperformer, right behind chips, yet pretty much everything is lighting up green in the weekly heat map for the ETFs. It was a good week for the stock market all in all. Even international markets were moving higher. But the consistency is important here, because a lot of you trade options, you get excited when tech moves higher. What do you know? You buy calls and the next day it drops down again. But the consistency right now, until it's changed, is in energy. Energy continues to move steady eddy higher and higher and higher. Moving on to charts, and beware, this might be confusing, but the market is at an inflection point right now. It is debating after the earnings from big caps. Is that enough to merit a move higher, or are we going to go back to the concerns about the Fed and the monetary policy, and hence the continuation of the bear market? And while the market debates in which direction it wants to go, it is really intriguing to watch, but it could also be dangerous for traders. If you bet the wrong way, you're gonna get smoked. And therefore, I'm gonna explore the bull versus the bear case in the charts. I don't mean to confuse you, but we have to explore both sides. We start with SPY, 30 minutes chart for the S&P 500. We're seeing this V formation, a gap down, a loss of momentum going all the way down to almost 443, and then bouncing higher again on the heels of Amazon's earnings. But look at where the chart stopped. Short of 451. It lost the support of 451 in a last 30 minutes candle flush down. What does that mean? Net, we're back to where we started from the gap down. We have yet to recover the momentum that was building on since pretty much January 24th, meaning that the market is now debating, do I go with Facebook's earnings Or do I go with Amazon's earnings? And in reality, do I go with the reaction after Facebook's earnings or the reaction after Amazon's earnings? Either way, it's a bad outcome, because Amazon's earnings were actually bad. The majority of the revenue came from Revvion, and Revvion stock is down big since then. So the fundamentals are bad in Amazon. The reaction was due to short covering. Yet the shorts are going to pile in again if the market doesn't find legitimate buyers, because the retail crowd can buy whatever they want. If the institutionals don't follow up and buy, the market is not going to move higher. They go ahead and pump on TV, on CNBC and the likes, but they want you to buy. They're not buying, and this remains the problem for the stock market. We're now looking at the support of 446.5. If that is broken, then we're looking down at around 444, and if that is violated, then run for the hills. We're going down to retest the line in the sand at around 430. Now, let's do this exercise by removing all the markings and indicators, the support lines, and shifting the aligned chart. What if this is a formation of a bear flag? And what if what we're seeing right now is a formation of an ABC pattern, in which the bear flag is going to play out, and sooner or later, we're going to violate the support of around 420. We're going to make a lower low. This is the bearish outlook. Now, here is the bullish outlook. The bulls will counter and say, whoa, wait a minute here. We're bottoming. It's a process. It's not easy. We're making higher lows. We hit the resistance at around 458, yet we're marking a higher low. We're going to gather the energy, and we're going to pop above 458 once again. It's a process. The debate is really intriguing. Both sides have a point right now, and hence we gotta wait for what? We gotta wait for the fundamentals. The market's gonna debate and digest earnings, but if earnings don't move the market higher, then what comes next in the fundamentals? The answer is the CPI and the Fed's rate decision. And if the market focuses on that, it doesn't look good. Here's the daily chart for the continuous contract for the SPY, the S&P 500. The good news for the bulls is the following. The chart is trading above the support of 4,472. The momentum indicators are getting stronger, be it the RSI or the MACD. So far, so good for the bulls. And they would argue, what if this is an ABC pattern? We made the A leg, we're now forming the B, and the C leg will take us back to all-time highs. Here's what the bears are going to counter with. Look at the volume. The selling is happening on higher than average volume, meaning that the momentum is in the hands of bears right now. And what if what we're seeing right now is a bear flag that formulated the A leg? We saw the B leg that took us all the way to around 4,549.5. And we're now seeing the formation of the C leg, which will take us to mark lower lows. And here is the daily chart for the SPX, the cash index for the S&P 500. We popped above the 200 days moving average, and the chart for now keeping the support of the 200 days moving average. Is this bullish or bearish? The answer is it is bullish. And perhaps what we're seeing right now is a formation of an ABC pattern, retagging the support of 200 days moving average and then moving higher in the C leg to retest the lower edge of the channel, and then perhaps getting rejected from there. So the line in the sand right now is the 200 days moving average. The bulls will have their case so long as the support of the 200 days moving average remains intact. The Qs, what's going on here in the Nasdaq from a 30 minutes perspective? A gap down, flushing all the way to retag the support of 352, forming the double bottom, and then moving higher to form the V shape. The problem is the move stopped short of regaining the 360 level as support. Can we say it is 100% bearish or 100% bullish? Of course not. We can do the same exercise, by the way, by switching to a line chart, and you will see the same thing that we saw in the SPY's chart in the Qs. It could go either way at this point, and therefore I say both the bulls and the bears have a case. The problem is we have to look at lines in the sand. If the Qs moves down to 352, if that retest fails, then we're going down to the line in the sand. And by then, it will become obvious that the bears are in charge. And here's the daily chart for the continuous contract on the Nasdaq, and you can do the same exercise that we did with the SPY's chart. The ABC pattern for the bulls, the ABC pattern for the bears, you will come up with the same conclusion. But the bears have a point here when it comes to the volume. The volume is moving higher. On the selling side, the bulls have three things. The support of 14,445 remains intact, and the momentum indicators, the RSI and the MACD, are all curling their way higher. So the debate remains intriguing, but in my opinion, losing the support of 14,445 will give massive advantage to the bears. The bulls must hold that level for dear life. And here's the daily chart for the NDX, the big NASDAQ, and we're watching the 200 days moving average. Unlike the SPX, the NASDAQ lost the support of the 200 days moving average. Is this bullish or is this bearish? The answer is it is bearish. So for now, we have one chart of the market, the SPY, which remains bullish for now. On the other hand, you have another chart, the NASDAQ, which remains bearish, at least for now. The debate goes on. What about the Russell 2000, the IWM, a 30 minutes chart? What's going on here? It went down to retag the support for 196.5 and it moved higher. The problem is it did not move higher by recapturing another support line, which would be 204.5. So for now, it doesn't matter to me. Sooner or later, you're going to lose the support of 196.5 if you do not capture 204.5 for support. And here's the weekly chart for the RUT, the Russell 2000. It is bearish. No doubt about it, because we're trading below the line in the sand, 2100. That doesn't mean that the RUT could not curl its way higher to retest 2100 for resistance once again before it fails. So we gotta keep an open mind here, but in this chart, the bears are in complete advantage. What about the Dixie, a daily chart? What's going on here? It moved down, violating the support of 96. Could it curl its way higher to retest 96 once again as resistance? It could. The problem for the dollar is that other central banks across the globe are becoming hawkish. We have many interest rate decisions this week for central banks across the globe. If they indeed jack interest rates higher, then those currencies will move higher and the dollar will move down. Until, of course, the CPI reading comes out on Thursday. And if it comes out really hot, then the expectations for a Fed hike will move higher and higher and higher. And hence the dollar will recover on Thursday. What about gold? Gold, not impressed at all by the move in the US dollar. As if gold is saying, watch out for Tricky Dixie here. It is faking the move to the downside. This is what gold is saying for now, and it is forming a bear flag pattern. If buyers don't show up for gold, it's going to move down to retest 1,763 for support. But the bottom line for gold investors is the following. Look at the volatility in the Dow Jones, the S&P, and the NASDAQ. Unbelievable. Ups and downs at extremes. Yet gold, when you look at the volatility for gold, it remains limited within a 2 percentage point limit. And all in all, gold is pretty much flat for the year. So you could say this is a win for gold investors, that they weathered the storm of volatility so far. But at some point, they want to see gold move higher. What about the 10-year yield, the daily chart? Again, we explained the behavioral element of the chart. Yes, we had a double top. Yes, we have elevated readings in both the RSI and the MACD indicator, perhaps signaling that the 10-year should move down. But so long as the chart held at 1.77 for support, this is an indicator of strength. And I told you, regardless of the double top, regardless of the so-called overbought readings, the 10-year will move higher because the behavioral element of the chart indicated exactly that. We're now eyeing 2%. It becomes a psychological target for traders to reach. And sooner or later, specifically if the CPI comes out hot, you're gonna see the 2% reading 100%. And that comes at the loss of the TLT. This is a weekly chart for bond prices, the TLT. It now lost the support on 140. And we're looking at 134.5 for support. So far, so good for yields. Not so hot so for bond prices. Moving on to the VIX 4 hours chart. What's going on here? Perhaps one of the most important charts to watch. Notice that despite the pop in the S&P 500 on Friday, the VIX remains elevated. It remains trading above 20. It didn't even close the gap. Look at the MACD indicator. It remains showing green impressions on the histogram. They're not getting larger, but all in all, does this chart favors the bulls or the bears when we talk about the market? The answer is it favors the bears because the VIX is trading above 20. It still has the momentum, at least according to the MACD. So until and unless the VIX closes the gap, and closes the day below the gap, and preferably below 20, the bulls are not out of the woods yet. And here's the 4 hours chart for the VXN, the VIX, for the NASDAQ. Unlike the regular VIX, the MACD indicator is not showing green impressions on the histogram. Yet the red impressions are getting shorter and shorter and shorter, an indicator of perhaps a bottoming formation in the VXN. Likewise, the VXN did not violate the lows from Thursday. All of these are good signs for market bears, that perhaps we have another shoe to drop in the NASDAQ. What I'm watching for is the level of around 27.5. Now, if that level is violated, meaning the VXN closing the day below that number, then we're talking about perhaps a bottoming process in the Qs, the VXN is going to cool down, or we will see another leg higher in the NASDAQ. But absent of that, the bears are still an advantage when it comes to the NASDAQ, according to this chart. What about Apple, the daily chart? It still looks good, but we're seeing signs of weakness here. Why? Because the chart lost the support of 172.4 by a penny, so we're not going to make a big deal out of it for now. But why couldn't Apple move higher when Amazon popped higher, when the entirety of the market was moving higher on Friday? This is a sign of weakness. And if the weakness continues, then Apple will go down to retest the upper edge of the channel once again. What about Tesla, the souffle in hourly chart? We saw a bear flag producing a gap down, and that was rescued right away by the so-called Tesla whale, who bought a ton of call options, pumping and dumping the stock immediately. But then we saw a formation of a bull flag, and that indeed produced a pop higher on Friday. The problem is, net Tesla remains trading within the same range. If it moves higher, we're going to retest 995. So in the hourly chart, the outlook remains neutral. On the daily chart, the bulls have the advantage. Why? We're trading above the trend line. We're seeing the momentum indicators, be it the RSI or MACD, curling higher, and they're about to cross the positive territory, producing green impressions on the histogram. So the bulls have the advantage from a daily chart perspective. The problem is, when we move on to the weekly chart, we haven't seen the lows yet, at least according to the momentum indicators and the chart pattern. And it gets even worse on the monthly. Look at the monthly chart, the MACD is way elevated, and it's about to cross to the negative side, producing red impressions on the histogram. The message is, on the shorter term horizon, Tesla is perhaps bullish, but in the longer term, this one is going to drop big time, because the bears who missed out on the drops in other stocks, they're going to look for names to short here, and they're going to find Tesla, the only high multiple names that remains elevated and has yet to be hit by the freak out about the upcoming monetary tightening, which will reduce down multiples, whether Tesla culties like it or not. On top of that, we have the margin call risk, meaning if we continue to see losses in other stocks across the market, one of the largest holdings by retail investors is Tesla. Sooner or later, the margin calls are going to hit this name, so tread carefully. Lastly, what about BTC, Bitcoin, tulips? What's going on here? We're taking the bear flag out of the picture right now because we saw a massive pop on Friday, erasing the bear flag pattern. And we're now looking at 42,000 for resistance. This is a good sign for market bulls, and the reason is it indicates perhaps a risk-on environment as we see buyers finally showing up and buying the dip in tulips. And it's really one whale that bought the dip here, and here is the identity of this whale. How about Senator Ted Cruz, aka Lying Ted? He bought 50,000 worth of Bitcoin. Ted bought the dip, and he's scoring big right now. And I say, let's trace that 50 grand carefully, because perhaps this explains where Lying Ted is going to spend his gains, his crypto gains. Here it is. Bitcoin has become a lifeline for sex workers, like this former nurse who made $1.3 million last year. So perhaps Teddy wants to use his Bitcoin gains for his OnlyFans subscription. And last time I checked, this is what Senator Ted Cruz does in his spare time. Anyways, we're gonna move on to the conclusion of this video. What do we have on the economic calendar this week? Monday, we have consumer credit. Tuesday, we have the small business index. Wednesday, we have wholesales inventories. This will be a revision, not that important. And then Thursday, the most important day by far, because we have the initial jobless claims on top of the very important CPI reading and the core CPI. And lastly, on Friday, we have the University of Michigan Consumer Sentiment Index. And before we close the show, here's what we have on the earnings calendar this upcoming week. On Monday, meaning tomorrow, we have Tyson. We also have Amgen, Simon Properties, and Take-Two Interactive. Tuesday, we have Pfizer, Harley-Davidson, Chipotle, Peloton, and Lyft. Wednesday, we have CVS, PepsiCo, Toyota, Yum Brands, Mattel, Disney, and Uber. Thursday, we have Coca-Cola, Affirm, Expedia, and Twitter. And lastly, on Friday, we have Under Armour and Goodyear Tires. And with that, folks, I'm done here. This is all I got for you for now. Thank you for listening. Thank you for watching. I will talk to you again tomorrow.